The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the Unite.
Welcome to Easy Money New England.
Oh, can somebody help us here?
We can, because we are real estate and mortgage professionals.
Here you go. Come in and browse.
That's right. Come on in, listen up and learn.
How long? Here's about.
In a short period of time, our panel will teach you some tricks that might make your house buying easier. You might not be looking for a mortgage today, but we'll get you ready.
You don't look like browsers.
Are you looking?
Oh, what do browsers look like?
Maybe I'm half rough.
On his father's side.
This is Easy Money New England.
Let's show the lady what's up.
With your host, Brian D'Amico.
One more win out of you and he gets it, alright?
Hello, welcome to Easy Money New England, where every week we will bring experts in the industry, in the real estate and mortgage industry, with money-saving tips or money-making ideas. And today with us we have Dan Crowley, who is the owner and president of his own commercial real estate company. And I've been working with Dan for over 9 years, and we've done a lot of deals in the past together. And he's a great resource in the commercial space. And I like to say he's one of the smartest guys I know. So let's welcome Dan Crowley.
Oh, thank you very much, Brian. I appreciate it. It's great to be here. I don't know if I can live up to all the lofty platitudes, but I feel like a mosquito in a nudist colony. I'm excited to be here. I just don't know where to start.
All right, well, Dan, I mean, this is our first podcast, and what better than to kick it off with you and talk about, this might be a money making or a money saving episode, and I'll let you kind of bring it in. Like, for example, commercial real estate is anything over 4 units. It also can be two apartments over 2 storefronts, or if it's a mixed use building. So, Dan, with that being said, everyone always says, is this property commercial? And they say, well, how many units is it? They say 5 units. Well, it's commercial.
Correct.
So, maybe talk to the studio audience of, how commercial real estate and how do you make money with it?
Well, it really comes down to, if you're an investor in property, number one, deciding which part of the market you want to go after. And in my opinion, simply because I come from a mortgage background as well as from an investment banking background, one of the things that's really important to determine is, how heavily invested personally do you want to get in the real estate that you're involved in, and what's your methodology? What are your goals? What are you trying to accomplish over the long haul? And bigger in many cases is better because you can get more diversification. You can have lower risk because you've got a greater number of tenants to diversify your financial risk. And then in other cases, it's a little overwhelming, and folks would like to be involved in a smaller piece of property. But the distinction is the minute that it stops being a 1 through 4 family property, unless it's raw land, technically it's commercial.
Right. So, how many families or how many individuals have you seen create massive wealth just by you following them through all of their different commercial real estate needs?
Well, the exciting thing about it is that commercial real estate falls into a variety of different categories. One category would be investment property. The other part of commercial real estate actually is a property that happens to be attached to an operating company that may be a family business. You're in a number of different family businesses, but you're also, as a family, involved in investment real estate. It's been a tremendous pleasure over the years to be able to work with you and your brother and your dad with regards to your own growth and success. And the idea that someone has grown their real estate portfolio from a very young age, when, for example, your dad, when most kids had a paper route, your dad was buying property. Right. And so there's a great example of somebody who started young and it learned the dynamics of the business and decided to become an expert in their particular geographic area. And over the course of the last 15 years of working in commercial real estate from the finance side, I've underwritten a little over $3 billion worth of real estate. And it's been everything from the smallest barber shop in New England, got financed through an SBA 504, all the way up to one of the largest portfolios of assisted living and skilled nursing care facilities.
Well, let's talk about that a little bit, about the SBA programs. Like, for example, I know a few people we put in an SBA loan. You can actually, most people think you have to put down 20-25%, which is actually pretty true. But when you go to an SBA loan, if you own that business and you occupy that property, you can get into a commercial property for as little as 10% down.
That's correct. And not only that, you can either buy a piece of land that you intend to develop into the property that's going to house your business, or you can buy a ready-made building that's exactly perfect for your business, or you can actually go between the two. You can end up buying a piece of property that requires maybe some significant or insignificant or minor retrofitting, but you can actually finance up to 90% of the purchase price of the property, along with the permanent improvements to the property that are going to be specifically germane to the business that you run, that are going to remain permanent improvements. But 90% financing is terrific. And the nice thing is the portion which is guaranteed by the SBA, which is the second 40% out of the total of 90%, is actually a 20-year fixed rate mortgage. So you're looking at completely level debt service on that junior mortgage piece for the next 20 years. And the rates are great right now.
Right. So, I mean, and that's a great thing for everyone to know, that you can actually, if you're occupying the building that you're in, you can actually buy a property for 10% down.
It just happened down the street from your office, as a matter of fact.
Yep.
Yeah.
Yep. So, I mean, and then you also do some bigger scale things. I know that you get involved in the builder developments. I know you've done some over the years, and I know you've done a lot more than the ones that we work on together. But
Sure.
I know you do quite a bit. And, what are some of the, say, can someone go out of residential investing and do an exchange and get into commercial real estate?
Absolutely. And again, it comes down to what's their long-term objective. If they've been
To make easy money, but that's not, there's no such thing.
No, you know what? Easy money, it takes practice and it takes hard work.
No such thing we like to say here. That's the name of our show.
But it's not just the deal that you do that's important. It's also identifying the deal that you shouldn't do. Right. And the difference between commercial and residential in particular when it comes to financing is that the economic drivers that cause a decision to be made that a property is a good property for investment is extremely clear-cut. Rule number one in commercial investing when it comes to commercial finance is that if it's a good deal for the bank, it's a tremendous deal for you, for the simple fact that there are buffers in the way that a loan is made which guarantee there's a margin of safety for the bank. Well, if it's good for the bank, it's even better for you because you will not necessarily operate that property with those buffers being an actual impactor on your cash flows. So your cash flows are going to be better.
So if you could explain a little bit, I know that, in a residential world, it's really, what's your credit score? How much do you make? Whereas commercial, it's more like, what's the rent roll? And, how, does the building make money on its own? So it's not your typical qualifying process that you would have in the residential mortgage world.
It's completely the opposite. In fact, while credit is important and everybody should do everything that they can to preserve their credit rating, that becomes the last level of consideration in a commercial loan. I mean, ideally what you're looking for is, if you remember the old phrase, it's a cliche, it's cash is king. Well, in the case of commercial real estate, cash flow is king. Positive cash flow is absolutely king. And the relationship between the cash flows of the property and the valuation of the property actually do not always run parallel. Folks will end up thinking that they want a certain price for a property they're selling, and then will be unfortunately surprised when they find out that the loan support for that, based on the positive cash flow, which is all the collected rents, less the natural expenses, plus some of those buffers that banking puts into it for that safety margin that the FDIC and the OCC require, ends up causing there to be perhaps a different opinion of what the value of the property is. But it's really a perfect world, because whereas in a residential 1 through 4 family financing, you can make up the difference with your personal income. And you might be able to overcome certain hurdles based on the fact you've got an extraordinarily high FICO score. In commercial real estate underwritten from a standard commercial underwriting approach, if it doesn't cash flow, you can't make a bad deal, which is really terrific. It's exciting for people when they realize
security
that.
There, if the bank's going to give you the money, you're good.
Yeah, and not only that, at the same time, never pay for value that you're actually going to have to take either a financial or a personal risk in order to create. Meaning that if rents aren't where they need to be to essentially justify the price, there's some negotiating to be done.
Well, with the increased equity out there right now, and I'm sure many people that own commercial properties, they're saying to themselves, well, I only owe a few $100,000, and I know that my property's worth a lot more. Have you seen anybody actually leveraging the commercial real estate to either one, buy more property, or two, maybe do an exchange, or buy, maybe sell that property and go into another one with increased cash flow? What are you seeing with the increased equity today?
We're doing a deal right now for a terrific guy, actually not located very far from your offices in Linfield, who is actually in a particular bakery style business, owns a particular strip mall right now where he operates his bakery operation, and does have a certain amount of equity that's available to him in that particular property. The interesting thing about it is he's owned the property for a number of years, has not necessarily seasoned the rents up to the level that they could be. But what we've just come to the conclusion is that he was looking to refinance that property with the idea of using the available equity to go out and buy something else. And what he'd be better off doing, actually, is to vacate that property with the amount of equity that he's going to get, which is in this particular case right around $100,000. And because that $100,000 in the realm of a new purchase to do with a strict investment property would only, on a multiple of 4, give him $400,000 worth of buying power. What we basically came to the conclusion, the better move for him is that he can actually maximize the rents with the space that he vacates, and he can go out and use that $100,000 to buy $1 million worth of building that he can occupy with his bakery company.
Yeah, that's a little, that sounds more Dan Crowley-ish. I mean,
and that's with an SBA 504. That's with an SBA 504.
Right. So when Dan gets into his algorithms and Excel spreadsheets and your software programs, you can kind of plug this information in and get back to that customer and give them real live advice. Because do you work with a lot of different banks when you go and shop for that best rate or best structure?
I've got a nice network of people that I'm fortunate in a lot of different ways. 50% of the things that I do are actually consulting into the banking industry, and the other half of the time I'm actually playing Match.com with good customers who need a good banking relationship. Now, in some cases, they're walking into commercial finance for the very first time completely cold. They don't know anybody in the business, and there's a lot of trepidation. There's a lot of fear, and it's a natural fear because it's new. Anytime you talk to anybody for the first time, technically, we're all afraid of two things. Falling and public speaking. And we're doing one of them now, and I'm still in my chair, so I haven't fallen. But when you're talking to a person for the first time, especially when you're talking about numbers and you're talking about commercial lending, that's a form of public speaking. It's horrifying. So the banks that are out there, for many of the banks that I like to do business with, we have a professional relationship where we actually are in an exchange of advice. But in other cases, I'm also a good source of business for them, and there's a level of respect and trust there that gives us an edge in the way that we're able to put a deal together.
All right, so let's talk about some of the property owners that are out there today. A lot of them don't realize that, banks only want to lend up to a certain amount. They might be a small bank, or they may, have to bring another bank in to do a larger deal. Let's talk about, when that level of that loan amount becomes $2 million plus. Let's talk about what you do with HUD, because that seems to be, to me, the best terms in the industry for commercial. When I bring this up to an investor, and we tell them it's 30-year note, rates are in the 3s, it's fully assumable, non-recourse. Everyone's like, sign me up. How does this happen?
Correct. Well, the interesting thing about it, what is traditional in the banking world, is that in traditional Main Street banking, community banking, commercial banking, you'll normally see loan structures that are in the 75% loan to value range, meaning that in the course of a refi and acquisition, right, exactly, or 25% equity.
Yeah, 25%.
And the comfort range is usually somewhere from a yield standpoint. They like to be on a 25-year amortization. For businesses, they may go down to 20 if they perceive there's a little higher risk,
which is still good.
And they may stretch it out to 30. Which is not the norm, but is available.
I've seen that a couple times.
But when you start to get into larger property, when you start to get into institutional grade property, which is in that $2, $3, $4, $5 million range, you start to open the door to an entire range of government agency insured loan products that are offered through HUD, FHA, Fannie Mae, Freddie Mac. And the family of products that in particular are my favorite happen to be the HUD products, simply because they will, if you're a developer of a property that is going to be developed for the purposes of generating income, you're looking at the potential for a total financing that could be up to 95%, that will end up being a construction to
Did
permanent
you say
loan.
95%?
Yes, depending upon whether or not that property sits in a certified federal redevelopment zone, you could actually qualify for a variant of the 221D4 program that would allow you to borrow up to 95%,
Wow.
40-year fixed rate non-recourse and assumable financing.
40 year?
40.
Okay.
40. Full term 40. Doesn't change every 5 years.
I hope I'm around 40 years.
Yeah, I know it. So what it really does is that it takes it takes that particular asset, and if you were to put property A next to property B, and one was financed with a traditional bank note, and one was financed under that particular HUD product, what you really have done is you've turned that real estate and you've really turned it into more of a multi-generational annuity, simply for the fact that you've locked the rate for 40 years. Now, we've been through an amazing rate cycle over the course of the last 10 years. We went through very high rates leading up to the economic crash, and they've been artificially suppressed for the course of the last 7 or 8, 9 years. And now they're talking about bumping them a little bit, but the economy probably would not withstand a huge jump. So you're looking at rates still in that acceptable range. Right now, bank rates are in the mid-4s, which is not bad.
But what a HUD rate is? The bank rates in the mid-4s. What's the HUD rate?
The effective HUD rate would generally end up being lower, but for the purposes of making sure that it did not become a moving target during the approval process, it's going to be underwritten at a buffer above what the actual rate will end up being, to make sure that the whole loan package and all the effort isn't put forth, and then having this massive move in rates that nobody predicted. And spikes in rates do happen. But when you end up with that property stabilized on a 40-year basis and the rate doesn't move, and you're looking at the effect that's going to have on your family, you've done two things. Number one, you've changed the nature of the property. Number two, you've changed the nature of your expectations of what real estate can do for you. And it causes you and it forces you to want to hunt at a higher level, quite naturally, because let's face it, the structures are attractive.
Right. So we see it on TV everywhere. We see flip or flop, or we see these different things that, there's a bunch of guys flipping properties, and, when times are good, it's great. But,
of course.
In 2008, when we saw the big crash, I didn't see big investment portfolios, getting, it was ironclad because that income coming in every month. They really didn't get it hurt as much as the people that were buying on speculation or flipping.
You go through an appropriately careful process when you're doing one of these loans. All right, it's just as much to protect the borrower as it is in this case the lender, which is in fact the federal government. The loans that are made out of these programs are actually the collateralization. They're the actual collateral for what everybody knows to be called Ginnie Mae securities. So, the government doesn't like these things to default, and they don't want to see you fail. The failure rate on these is extremely low. It's ridiculously low.
And when you say it's generational, it's generational income, it's because that loan is also fully assumable. What does the fully assumable mean?
What it essentially means is that you're doing a 40-year loan. You're developing a piece of property or redeveloping a piece of property that, in many cases, let's just keep it simple. It's an apartment property. And right now, you're raising your own young children. And at this particular point in time, you will probably live to be 40 years older than you are today.
Hopefully.
All right. But you may not want to be, you may want to do some sort of estate planning, and you may want to have an exit strategy for your active involvement in the properties. And with 40-year fixed rate financing and the ability actually to do a very economical refinance within that structure, depending upon whether it makes sense to interest rate wise or not, your kids are looking at a completely different cash flow profile, positive cash flow profile, than a property that is underwritten based on a 25-year amortization and where that rate is subject to change every 5 years, which is still a great structure. But if you can start to matriculate and graduate up into those areas in terms of the size and the type of properties that would qualify for government-insured financing, you really want to strive for it. I mean, you want to move in that direction over the long haul. It's going to help you, your kids, and when you're not looking at a rate change, it's pretty easy to predict what your cash flow is going to look like when you can predict that your rate isn't going to change for 40 years or 35 years.
It's great information. I mean, I get this question a lot because, obviously I own a mortgage company and it's residential, but I always get the question, do you do commercial loans? And I say, well, you could see my friend Dan Crowley. He's definitely the best in the business. And, some of the questions that always pop up is, how much do I have to put down? if someone's listening right now in their car or their house, what information do they need to get you to kind of break this down to tell them, and how quickly can you figure it out of this? Does this property cash flow, and what's the interest rate, and how long would it take to close?
Well, basic property description. If they're a refinancer of property, because what people are finding out as time goes on, that in many cases they'd like to change their banking relationship, or they'd like to really start to speak to their banker in a way that's going to raise the level of respect and really have more of a peer relationship with them. But with good solid information with regards to maybe if it's a property that is currently owned in portfolio, a Schedule E is pretty much all I need, along with the rent roll for the property based on the most recent month
Schedule
collections.
E being on your tax return.
Yep. Or if it's an LLC return, there'll be a Schedule E equivalent.
Yep.
And it would give me the same information. In terms of plugging it into the analytics, it'll take a whopping 5 minutes to figure out where the deal will qualify, and based on the range of loan structures that are available.
So as long as that information is accurate, that you pop it into your system, you can get an answer within 5 minutes.
Garbage in, garbage out. But if it's
Right.
good information, the answers will be accurate.
Yeah.
And we can actually calculate what exactly the buying power would be for that person. If they're looking at extracting equity from property and going out and shopping, depending upon the way they're going to do it and the nature of the property that they need to buy, is it for their business or is it for investment?
Yeah.
Again, it's going to, let's put it this way. If we're looking at a $200,000 extraction of equity from an existing property and someone wants to go out and buy another property, it's in a general 75% loan to value world, assuming that we're dealing with a transaction that is in the bank category, you're looking at about an $800,000 worth of buying power. But if they're looking to go out and actually buy a property for their business, they're looking at $2 million worth of buying power.
Because you're taking that revenue from their business and actually putting that into the deal.
Correct. But what you're
Gotcha.
looking at is that you're looking at the ability to finance up to 90% under the SBA's 504 program.
Right, which is a great program.
Oh my God, yes.
It's a great program.
It's tremendous.
Maybe talk about a little bit. I know the question I get a lot is, I have a 6-unit or I have a 12-unit building. I'm thinking about condoing it. Now, is that residential or is that commercial?
Well, if they own it and operate it today, it's commercial.
Right.
All right. But if they're going to turn it into a condo, they have to talk to you.
Right.
Because what they're essentially looking at is, let's say that it's a tired 6-family. Let's put it in some context. And right now it operates on a gross basis, meaning that you pay all the utilities as the owner. It's on a common water tank. It's on common heating. You're on public utilities, and you're paying them all as the owner. What you want to do is you want to condo the property, which means that you either come out of pocket so that you can separate all the utilities, get it all separately metered, and then end up creating an association so you can then create the ability to transact the units individually. A couple of different ways to do it.
Yep.
One way would be is to refinance the property to raise the proceeds that you need in order to be able to to do the work to be able to divide the units. The other way would be to actually borrow money against the property in terms of a construction or a convertible note or a rehab note, and then you pre-qualify
For the
potential buyers on the other end,
we'll take those end loans.
and then find out what the as completed value of those units is going to be in the marketplace. Because that's the one thing about making the conversion. You may have a perception of what those units are going to be worth. The property's worth X today based on its ability to generate cash flow as a commercial property. And it most certainly will be worth more than that when you turn those into a multi-sale unit situation based on dividing that into a condo. That's happening all over the place right now in Somerville, for example.
Yep.
Just did a
Great
6-unit
market.
in Somerville.
Yep.
And we see a lot of that happening in metropolitan Boston right now.
All right, so we're talking a lot about apartment buildings, but in the commercial space, it's much wider than that. Like, for example, public storage units. I know that's a big everyone wants a public storage unit if they could find one.
Oh yeah.
I know that I was paying for storage. It's about the same amount of money that it was if I was to rent an apartment. I mean, it was getting out of control. And then you realize that all the stuff you had in there wasn't worth the amount of money that you were spending to keep it there. So
I'm in the process of financing right now a 120,000 square foot new construction
the public storage.
for a public storage facility, and it's going to be one of these climate controlled drive through key card in, key card out type of facilities that really is like the Taj Mahal. This place is going to be beautiful. And there's a perfect example of this exact particular property that exists right now in the Burlington Wakefield area, which is pretty much the model for the one that we're financing that's going to be built. But the idea is that the fastest growing part of the economy right now are the empty nesters, the baby boomers who have already boomed, whose kids have moved out. Mine did. Mine are married, at least one. And people have many more things that they cherish in many cases than the square footage that they're going to migrate into. And consequently, that's a great investment. Simply because people don't want to part with their dear belongings as quickly as the space would dictate that they would have to. They want to visit their stuff.
Right.
So, we're
restaurants, public storage. What other types of properties can you think of?
We're in one right now. Do we need a loan here? I mean, we can refinance this right now and extract some equity. But we're in a commercial property right now that is
Two Guys Smoke Shop, actually Studio 21 Podcast Cafe.
This is a pretty slick place. I got to tell you, this is an awesome environment.
Love it.
And this is a good example of a mezzanine property in terms of multiple uses. You got a terrific cafe over here.
Yeah.
You got one studio here. We're in a great cafe studio setting right here, but downstairs is a tremendous retail operation.
Right.
And this is an example of a multi-purpose commercial property that has multiple revenue streams and actually is pretty well diversified because of it.
Right.
So not that we're inviting competition, but this is a great property. Unbelievable traffic count.
Yep.
And this place would just appraise amazingly. So. Talk to you later about that.
So, all right. So we talked about the different types of properties. If has anyone? I mean, I get a lot of questions. Again, is people, with the increased equity and thinking about, what's the best use of this equity or the best use of, a lot of people don't want to be a landlord anymore. Being a landlord, it's not easy money. That's for sure. It's a lot of work. I know some people make it look easy, but it's not. There's nothing easy about it. But if someone was looking to maybe sell their property and go into a triple net lease, what are those things called?
Well, are they going to go in as a business or are they going to go in as an owner of multi-tenanted commercial property?
Well, a triple net lease, I know that you pretty much just get a return for your money, right? So if you're buying, like 6 Wendy's or something like that, where the revenue just comes in, you're not really being a landlord. They're paying for all their own expenses.
That's essentially a pad lease, is what they're talking about,
yep.
And that is, very often. In fact, we're on the Strip right here in Salem. We're in Broadway.
Yep.
And all up and down the Strip, there are properties which are strip malls, office buildings, what have you. Many of those properties actually do have a pad component, which are on the same legally zoned plat, and that's actually a land lease. In many cases, it's a land lease to a nationally rated company.
Yep.
Could be a CVS, could be a Walgreens, could be a Wendy's.
Yep.
It could be any of these particular companies that carry with it a AAA bond rating.
Right.
And frankly, those are leases that you can take to the bank, literally, and there is zero effort. Those are a full triple net pass through of all expenses.
You get your check every month. You're not getting no calls.
You're literally a landlord,
right?
In that case, because you own the land,
right?
And all your responsibility is to deliver it environmentally clean.
So how do you find projects like this? I mean, I know it's very difficult to say you want to sell a property, do an exchange, which is 1031, which will be one of our subject matters coming up in the next few months. But if you were to do an exchange, can you exchange into a triple net lease type of place, and where do you find them?
Well, you can do a 1031, and in what you'll find is that a lot of folks with very mature portfolios have gone through and done the entire depreciation game that they can possibly do, and they're looking to move on and essentially kind of recast that net out into the water based on the equity that they've developed. It does sometimes mean that they have to change asset classes, and they have to move away from properties that they've actively managed. They're folks that have probably been in the apartment business for a long time,
right?
And again, it's a situation where somebody is always looking to buy. There's always a reason to trade,
right?
And frankly, the idea is to find the middle ground, find the win-win in every one of those transactions. Sometimes the 1031 exchange ends up being the game maker for one
Right.
of those transactions, simply because it doesn't make sense for the seller to sell.
But yet deferring, you're going to pay the tax when you sell that property. You're going to basically get hit again if you ever to sell that property. So you're kicking the can down the road.
You are, but you're deferring it. Now, but the other thing you can also do is cost segregation, which will allow you to do some different things with your depreciation. And if you've never heard of cost segregation and you own multifamily or investment property out there and you've owned it for a period of time, ask your CPA about cost segregation, because depending upon where you are in the cycle of ownership and how long you plan on maintaining your ownership in a particular property, cost segregation can help you recapture massive amounts of tax dollars during a certain a certain period of time, depending upon what your long-term intentions are.
That's great information. Dan Crowley, it's first podcast, and I got to say, sometimes the first off is the best when you get on a piece of real estate. This could be our best podcast. It's a lot of good information.
You know what? It's fun. This is great.
Right.
You and I do this on the phone all the time. It's pretty funny to do it.
Not many people think commercial real estate is fun. But Dan Crowley does.
I was dropped as a baby. I don't know.
But this is fun for you.
Yeah, it is. It's a blast.
How we doing on time? We're doing good. All right, great. So Dan, I know you don't want to talk too much about your new system coming out, but I know that we want, as a mortgage originator shop, we want the ability to be able to go into a system and say, hey, I got this customer, I got all the information. Dan, I got your software. It seems to work. What's going on?
Basically, what we made is we made a fundamental decision that the secrets and what a lot of people would consider to be the trade secrets in commercial banking. Folks would be better off if they knew, as opposed to just walking in blind and saying a Hail Mary and praying they get an approval,
Right.
and then wringing their hands for days on end, wondering where they're going to be. So what we're doing is we're creating let's call it, in the global sense, an educational environment.
Yeah.
Where folks are going to be able to sit down, learn how the system works, and then be able to act upon it with a level of confidence that will allow them to go further and go confidently into the marketplace, either in the context of understanding how their property operates today or investments they may want to make. But we're ready to equip folks with a level of knowledge and empowerment that will allow them to be able to be more effective, have a better relationship with their existing or their prospective banker, and even help them find a new banker if they felt that they needed to. But if for anybody who'd like to be on the waiting list for information as it becomes available, either from the educational standpoint or from the analytics standpoint, all they've got to do is go to bcrworks.com/connect and register. And as the information becomes available, all you want to do is to put in with your name the promo code Easy Money New England.
Easy Money New England.
They'll be able to get on the mailing list and be notified when things become available.
Even though there's no such thing as easy money. So
there isn't. But let's make it easier.
Right.
Let's try and make it easier.
Well, that was great information, Dan. And I just want to talk about a little bit about Easy Money New England and some of the shows that we do have coming up in the recent weeks and months ahead. We will be talking to a local company called NRG Tree, and they'll talk about, is solar right for you? So basically, this company will, you type in your address and they'll design the system for you, and then they have an auction site out that says how much it would cost, how much you would save, and then you can make a decision based on all the offers that you get to go solar, which I think will be a great program. We also have Hod Gill. He has a program called Speed Equity, how to pay off your home years sooner. That's a real good one. I'm actually using the product now, and I'm seeing some great results. I'm excited about that one. I'd also like to have a show just about flipping versus buy and hold. I think buy and hold is the right strategy. I had a few flips myself, and they were absolute flops. So, all those people that are making flip profits out there. I don't know.
Very brave to admit that, by the way.
I'm not a flip guy. It was awful. It was really bad. And then, but it was an experience.
Yeah.
So, I got 4 years I could have went to 4 years of college, but at least I got a good experience out of that one. But, selling your property tax-free as a 1031 exchange, that's also a great subject matter that we want to dive deep into. And I think it will create a lot of opportunity for our listeners to really increase their cash flow. That's really the name of the game. Yeah. If you can increase your cash flow, that's the name of the game. I never knew what cash cash is king meant until 2008 hit. Then I realized what cash is king for
Oh, yeah.
sure.
Yeah,
And then we'll talk about some specific mortgage products like a 203K, a construction mortgage, those types of programs where people always have a question: can I get into a home with 3.5% down? Yes, you can. Actually, 3% down. If it falls inside of a USDA area, you can actually buy a house with no money down. So all great products. Again, FHA and USDA are government products. 3% down with Fannie Mae. We'll also talk about that as well. But if anyone has any ideas or anything they want us to bring an expert on the panel, we will bring an expert to talk about the subject that you're looking for. In the meantime, you could email us at info@newfed.com. That email will go to me. Again, it's info@newfed.com. Tell us a subject matter you would like to learn about, and we will get an expert in the area. Anything that's related to real estate or mortgages.
That's exciting.
Yeah.
This music.
Ronnie Dangerfield.
Is it really?
So,
hey, this was
just
fun.
want to say, Easy Money New England, our first show, number one.
Unbelievable, isn't it?
Yeah, and I think that no such thing as easy money.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.